I think they're fighting like rats in a sack now, trying to short cover these massive shortfalls because nobody is there to help you anymore. And literally, you can't print silver. You can print more money to buy more gold at a higher price, but there just isn't the silver there. It's just not there.
Yeah.
So how the hell are they going to extricate themselves from this position? That's why they're in backwardation into a delivery month. Where does that extrapolate out?
Yeah.
To me, it's $80. That's where it extrapolates. The reason that we're seeing less volatility and the reason we won't see these kind of big sell-offs again, there's just simply not the liquidity to do so. It's gone. It's literally gone into physical markets.
A growing divide between paper trading and physical ownership is reshaping the gold and silver markets, and Andrew Maguire argues that this split is now more visible than ever. He says that Western futures exchanges are now dominated by a small cluster of aggressive speculators who control roughly 85% of remaining open interest, turning COMEX into a momentum-driven arena detached from real supply. Meanwhile, major institutions, refiners, producers, industrial users, and sovereign buyers have largely stepped aside, abandoning a system they believe no longer offers fair or transparent price discovery. Their shift toward physical exchanges in Asia has left speculative traders carrying excessive, fragile positions. According to Maguire, this year's major breakouts in both metals drew momentum players into large, leveraged long positions, expecting sustained upside. Commercial banks, operating across both COMEX and the LBMA, quickly countered that enthusiasm by shorting into it, using detailed visibility of order books to identify where forced liquidations would occur. Once pressure was applied, cascading margin calls erased speculative positions on both sides of the market. Yet despite this engineered volatility, Maguire points out that gold remains up dramatically on the year, and silver continues to trade well above its earlier breakout levels. Evidence, he argues, that physical accumulation now outweighs paper manipulation. Maguire concludes that the traditional Western pricing structure has effectively hollowed itself out. With institutional participants gone and liquidity thinning, the futures market cartel no longer can trigger the massive price collapses seen in past cycles. In contrast, China's SGE and other physical-only trading corridors require sellers to possess the metal before offering it, anchoring price to actual supply rather than leverage. In his view, this signals the emergence of a more stable, physically grounded market framework, one increasingly driven by real consumption, tightening inventories, and a global shift away from paper-based price control. Now, we present the clips from Michael Oliver's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
You've just outlined what was the classic wash and rinse cycle. And of course, you know what it is. I mean, it really annoys me. It's part of the system, but it really annoys me when I call them a pestilent group of speculators who decide that, hey, I'll chase momentum in any way. Now, these guys control, momentum traders control pretty much 85% of all the remaining open interest. Most of the open interest from real institutional guys disappeared. I don't want anything to do with that COMEX anymore. There are plenty more physical exchanges, and we know where they are, where they get treated better. If I'm a refiner, a producer, or anything anything where I depend on a real price, why would I have anything to do with this toxic mix of prices that sort of comes together? If I'm to take a position, it's visible. There's only a couple of big guys controlling the book. And of course, they're going to take you out. Of course they will. And they do it on a regular basis. So momentum traders, to answer your question, here's what happened. So they decide it finally breaks out. What do? Oh, we're going up this time. So they hang on to the coattails of what is actually a physically driven market. But they get so much bloated open interest. So all you need to do is, of course, in the meantime, the COTs, the same guys that we know that operate the LPMCL pretty much, same footprint in both markets. And what do? Go short against every single one of those guys, knowing, guess what? When we get to let's go to just about there, margin call. Oh, let's do another one. Bang, out they go. What they've done is they've literally popped the bubble. Thank goodness, good riddance to the whole lot of them, because essentially all that did was put them into the other mode of shorting the market with the same commercials taking the long side of them. So by the time we get this equilibrium that we were just talking about, these guys are pretty much out, long or short. They've just been rinsed of their shorts. So I think what we've done is just establish the next in the series of higher physically supported steps. That's been the process. And my goodness, Craig, I mean, what, we're $2,000 up from, we're like $23 higher than the beginning of the year, over $1,500 higher in gold for the beginning of the year. I mean, you only have to step back and look, take the chart chatter out of it. What a good marketplace this is. And it's not being driven with the Western cartel, basically. And I think they've really, to me, they've blown it. They've lost all the good clients. They've lost all the institutionals. They're now reduced to gaming, a very few, declining open interest really any open interest that's in there is just really mostly speculative. And I think the parameters of that are so contracted, whereas before you could create a $500 waterfall. Sorry, but in this is a lot of physical buyers where you have to, who operate in physical exchanges, as you know, where you have to buy that bar if you want to sell it, as opposed to just putting 4% of skin in the game, 96% leverage position, which is just chasing a price, a dot on the screen. And all we saw was this dot on the screen get squared up and off we go to a much higher stair step. The difference is, again, pretty much what we've just discussed about gold. It's the same in silver. The real actors are gone. And I think this open interest that's in there, it's very limited as to what they can actually rinse out, because we've got physical markets being set in China. We work with the liquidity providers who interact with the Shanghai International Exchange, and really looking at what they're talking about. There's very little. It's interesting because I think what really sums it up, and you and I were talking about backwardations a little while ago. While we have unprecedented backwardations, we've seen $3 backwardations in the past. They get arbitraged one thing and another, but so close to first notice of the largest delivery contract of the year. We're seeing on last Friday, 60 cents, $3,000 per contract offside. Now we're still looking at 20, 30 cents. I mean, ludicrous into first notice, through options expiry into first notice, which is actually supposed to be tomorrow, but it actually happening today because it's
goes off the board on Wednesday and trades first notice on Friday. Yep. End of the month.
Exactly. So, so what it tells us, what it screams at us is, hey, you can't have a backwardation, coming into a delivery month where it's not telegraphing to you, it's mispriced, severely mispriced. And I think the reason for that, Craig, is because the LPMCL's CME relationship, where they've got a footprint in both markets, haven't they? The liquidity spigot is broken. It's completely broken. They don't have liquidity anymore to be able to pull this back. And what you got, like 4 billion in SLV shorts, and some of that, there's going to be some legitimate hedging in there, but 4 billion odd in short positions. That means that if I own an SLV share, it isn't there necessarily, not if everyone wants it at the same time. And so I think it is screaming. I mean, to be honest, I think these guys are turning in on themselves. And like I said today in an episode, I think they're fighting like rats in a sack now, trying to short cover these massive shortfalls because nobody is there to help you anymore. and literally, you can't print silver. You can print more money to buy more gold at a higher price, but there just isn't the silver there. It's just not there.
Yeah.
So how the hell are they going to extricate themselves from this position? That's why they're in backwardation into a delivery month. Where does that extrapolate out?
Yeah.
To me, it's $80.
Gold continues to attract heavy flows from sovereign buyers, institutional reallocations, and investors seeking shelter from weakening global bond markets. Maguire highlights a major shift in sentiment. Large institutions are now openly discussing 20% to 25% portfolio allocations to gold, a level that would have been unthinkable only a few years ago. Because most U.S. funds cannot hold physical metal directly, they are moving aggressively into ETFs, creating a more durable form of demand that cannot be shaken out by routine paper market volatility. With allocations rising steadily and early signs of backwardation beginning to appear in upcoming gold delivery months, the market is setting the stage for a potential long-term repricing, driven by tightening physical availability. Looking ahead to 2026, Maguire believes Western paper markets are nearing a structural stress point where leverage becomes unsustainable. Persistent backwardation, widening physical premiums, and continuous liquidity migration toward Asian exchanges could undermine the dominance of Western benchmarks altogether. In such an environment, meaningful price discovery would shift to exchanges where metal must be physically owned before being sold, a system far less vulnerable to synthetic pressure. The only factors that could derail this trajectory would be a sudden collapse in physical demand or an unexpected reversal in sovereign accumulation, both of which appear unlikely amid rising geopolitical tensions and intensifying global debt concerns.
Silver is the Achilles heel of this same group of people. RPMCL are just the four banks that basically control the cartel, basically. And I think their liquidity is completely blown to smithereens. All the institutional guys, as we've just said, they've exited. And now you can still access, as an institutional trader, I can then go in and tag the SGEI gold corridor, which is opening up big time, can access an increasing number of vaults, gold and silver that can be traded with a real physical price that is much more stable than this unbelievable paper toxic mix that is thrown in. And it only serves. And I think the reason that we're seeing less volatility and the reason we won't see these kind of big sell-offs again, there's just simply not the liquidity to do so. It's gone. It's literally gone into physical markets. And if I'm a producer or a refiner or something, why would I want a price that's so volatile? I just want to know supply demand. People are owning a bar before it's put for sale. You have to own it before you can sell it, which tells me that if you put it up for sale, that's a proper price. I don't care what that price is. It's the proper price.
Right.
It's not a COMEX derived price. It's a physical price based on supply demand on the day, based on purely on that supply demand. That is how markets are supposed to trade. And we've been gaslighted, or many people have been gaslighted into believing that this huge COMEX volatility is the market. It just amazes me. Silver was just a little, was just the more obvious version of that. But yes, because it's hard to hide the footprints. But absolutely, this is, as we know, central banks, sovereign, institutional buying. Now, all of a sudden, we've got, for all the reasons you have, the cockroaches running around in your treasury markets now. And I think people are looking at it and going, hey, I really have never had exposure to gold. So institutional, traders, buyers are saying, I need some exposure. So the problem is, and this is what's confusing a lot of people, problem is a lot of these guys are not mandated to hold physical, especially the US guys, not mandated to hold physical. They can buy and sell shares and they can do it on a click of a mouse. They are now, as we know, we're talking about the 40, 2020. So we're looking at a lot of people coming out and saying 20% allocation to gold. Hey, can you remember any of this?
Oh my goodness.
I mean, it was like you wouldn't even have 1%.
Right.
You wouldn't have a 0.5%.
You're a lunatic to even bring it up.
Exactly. So now you've got all these institutionals. Now, the interesting thing is they can't necessarily buy physical. They're buying the ETF. Now, you and I are great. We don't believe in the last place I want to go and buy gold is an ETF. However, they have no choice. So, but because they're buying for keeps, they're not going to take delivery. They are going to own that position, and it's sticky. They cannot be rinsed. You cannot say, and in fact, you drop a price down, they'll buy more because they're buying more every day because they're moving from zero allocation to 20 to 25% and more in some instances for obvious reasons. So therefore, people look at it and go, oh, look, there's all this open interest building in the ETFs. It's not speculative. This is sticky stuff. And obviously the physical market is all we care about, but it actually is forcing, even though there's shorting going on in the GLD and one thing and another, it's still a physical market. And it's the physical supply demand is being set outside of the LBMA ring fence. Mm-hmm. And so therefore, it's back to same as silver. If I have a bar and I have to own it before I can sell it, I need a real price. I want a real price. You've got backwardations in December, although the next liquid contract is March. But when you look at, silver, sorry. Then if you look at January, that's already in technical backwardation. Mm-hmm. So it is happening. It is happening already. And now we're talking about 2026 and they're not even done. I think this morning I looked, there was still, 2,000 odd tons of, silver warrants floating around in there. And the thing is, there's a lot of people that I know and who are saying, well, yeah, we bought and we're taking delivery. We are taking delivery. Mm-hmm. Why? Because it's the only source of physical that I can get to my limit, to my actual limit. I can buy that. If that's the only source of physical, going to be banging on that back door, out it goes. So how can that possibly be, and that's mispriced. It's so grossly mispriced. And furthermore, even if it was more expensive, people would still be lining up to get it because there's not enough on offer to meet all the demand. So it is a toxic mix. And as I say, that's why I think these guys are like rats fighting in a sack.
If these developments intensify, silver is positioned to undergo one of the most dramatic structural shifts in its modern history. With physical inventories already tightening and industrial demand accelerating across sectors such as energy storage, solar, and advanced electronics, the metal could enter a phase in which availability becomes the central driver of price, not sentiment or futures activity. As off-exchange buying grows and more participants insist on verifiable bars rather than paper substitutes, the gap between real-world scarcity and exchange-based quotations may widen sharply. This could force a long-overdue repricing cycle in which silver breaks free from decades of suppression, climbing not through short-lived spikes, but through sustained pressure created by manufacturing needs, strategic stockpiling, and dwindling above-ground reserves. If global supply chains remain strained and emerging markets continue accumulating, silver may transition from an overlooked commodity into one of the most contested resources of the decade. What's your take on this shift? If you found this analysis useful, make sure to like the video, share it with others, and subscribe so you never miss the next major update. Thanks for watching.